Hey everyone, today we're going to talk about something that surprises a lot of people in retirement, and that's how being too wealthy can actually cost you more in taxes, sometimes even more than you pay during your working years. We're going to break down the hidden tax traps of retirement that come with building a big nest egg, things like required minimum distribution shock, Medicare IRMAA surcharges, Social Security taxation, and many more. And be sure to stay through the whole video because we're going to cover more than just that. We're going to talk about strategies that I'm using for current clients that are keeping their tax burden in retirement as low as possible. And over a 30-year retirement, this is projected to save these clients hundreds of thousands or even millions of dollars. And before we jump into the video, my name's Ryan Knoll. I'm a certified financial planner and founder of NIIT Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. Let's talk about what I think is one of the biggest, if not the biggest area of opportunity in retirement for people who've done a good job saving. And that's RMD shock, or delaying distributions from your accounts, which can cause a huge tax bomb down the line. So if you've saved diligently in pre-tax accounts like an IRA or a 401k, congratulations, you've done exactly what you're supposed to do. But by age 73 or 75, and this depends on when your birthday is right now, you're going to have to start taking forced distributions from these accounts. And these distributions are called required minimum distributions, and they're fully taxable. So if you let these accounts grow untouched, these RMDs can be massive. I've seen retirees who have $3-4 million balances facing required minimum distributions over $180,000, $200,000 by the time they reach their early 80s in retirement. That alone can push you into higher tax brackets, include a higher portion of your Social Security as being taxable, and spike your Medicare premium. So yes, waiting can cost you, often to the tunes of tens of thousands of dollars a year, or hundreds of thousands or millions of dollars over your lifetime. So the fix here is strategic Roth conversions, which are partial withdrawals early in retirement, which allows you to do something called income smoothing and can help reduce RMD exposure later on in life. It also allows you to be slightly more aggressive with the funds in the Roth account because theoretically this will be the last bucket of money that you touch in your life. So it's going to have a longer shelf life than assets that are currently being spent down. In addition, if the main goal is to pass these assets off to children or other beneficiaries who are younger than you, doing so in a Roth account is much more tax efficient. You're not only going to decrease your lifetime tax burden, but you're going to do the same thing for your beneficiaries as well. And this is because inherited IRAs, regardless of whether they're traditional or Roth, need to be liquidated by the 10th year of your passing. So if you passed away in 2025, those funds would need to be spent down by your beneficiaries by 2035, by the end of that year. And this is going to add taxable income to your beneficiaries' accounts if you've passed along traditional IRAs as opposed to Roth IRAs to them. So a Roth IRA, your beneficiaries don't have to pay taxes on those distributions. So leaving that money invested in the Roth IRA for 10 years and then taking out at the very end is going to be tax-free income to those beneficiaries whenever they have to be forced to take that money out because of the 10-year rule. Whereas a traditional 401k or IRA that they're inheriting, they're going to have to spread that out over the 10 years so they don't create a huge tax bomb at the end. So that might push them into higher tax brackets in the interim, especially if they find themselves making somewhere over $300,000, $400,000 a year, depending on what they're inheriting. I've seen firsthand clients who make $500,000 a year and are in their 30s and 40s now start having to take required minimum distributions from an inherited IRA that they've gotten from somebody else who's passed, pushing them into making $700,000, $800,000, $900,000 a year. And as a result of that, they're paying taxes in the 37% bracket at the federal level, plus the applicable state rates as well. This is creating a huge tax burden on the money that you've worked so hard for. So I'm going to break this down with some hypothetical clients that I have, John and Jill Smith, and we're going to show you how this can save money for not only you, but your beneficiaries over a 20, 30, 40-year time frame. All right, so what we're going to look at here is two hypothetical clients, John and Jill Smith. And what we're going to do before we start clicking into some of the reports and the planning that we're doing for these clients, so we're just going to go over the facts. So I want you guys to have a good idea of where John and Jill are. So looking at them currently, John's 65 years old, Jill is 60, so she's a little bit younger. They're both fully retired at this point in time. So next thing we want to look at is what are they worth overall? So we saw on the front page, they're worth about $5 million overall, and this is the breakdown. They have about $150,000 in current cash, a brokerage account of $1.3 million. Jill is a small IRA. The bulk of their wealth is built up in John's 401k, about $3 million, and they have a primary residence that's about $500,000. They still have a small mortgage liability at this point. So $4.96 million total net worth. As far as income's concerned, John's currently taking Social Security in the amount of $30,000 annually, and Jill's going to take Social Security at age 62 in 2 years. That's going to be roughly $17,500. That might not be optimal for most clients, but just to illustrate a point here, that's where they're taking Social Security. The next thing we want to look at is what does their expenses look like? So expenses, they currently spend $120,000 a year, $10,000 a month, and their mortgage is roughly $13,500, $13,600 a year. We're also going to assume that they live in Pennsylvania and their local tax rate's 1% and that the federal tax rate is what it is for everybody else. So that's just a general rundown of where these two fall in their retirement picture. So let's go and let's actually look at their financial plan. So what we're going to do is we're going to assume that John and Jill make no changes to their portfolio. What we're going to see here is a nice linear progression upwards of what their balance will be when Jill's passed away at age 90. So we have John passing away here because he's a little bit older. Now Jill's 90 here, we have her passing away. So you'll see the portfolio assets have grown from about $4.6 million, $4.7 million today to roughly $12 million by the end of their life. And their net worth is just over $13 million. And that's going to assume that they live in their house and their house has grown and just about doubled in value from where it is today. So you might be thinking to yourself, what's so bad about dying with $12 million in portfolio assets? And I would argue nothing, but I also argue that it's not the most efficient way to do things. So the one thing that we're going to do is we're going to go into just a baseline simulation that I planned for them. And the big difference here is that we're going to convert John's 401k to Roth dollars every year up until they max out the 24% tax bracket. So meaning like we know they're taking out a little bit of money each year to help and make ends meet. But what I want to do is I want to accelerate distributions up until they're maxing out at the 24% tax bracket level. If we do that, we estimate that they're going to add about $8.3 million to their portfolio value over time. And what makes sense is they're actually costing themselves a little bit more money up front. So we'll see it's about an additional $77,000 drawdown doing this in year one, cumulatively year two, that grows to about $133,000, all the way up till 2040 when John is 80 and Jill is 75. It's cost them an additional $184,000 to take on the strategy. But by age 81, a beautiful thing happens and they reach a crossover point, meaning that what they've paid in taxes is less than what they would have paid in taxes if they didn't take on a strategy where they were accelerating Roth distributions. And then we'll see that this grows year after year all the way until Jill's 90. Now we're showing that $8.3 million in net worth. But let's dig into the cash flows to see what's actually happening here. So where we want to start is the cash flow under the base facts. So you'll see if we look at cash flow under the base facts, like looking at this table, we have income flows coming in for them. This is John's Social Security in year one and year two. Jill's Social Security kicks in 2027. So they're making about $50,000 a year here. We're just adjusting this for inflation. Total expenses, which is the amount that they're going to pay in their living expenses, which is the $10,000 a month, plus their mortgage, plus some taxes that they're paying as well. So this is all being factored into the total expenses. So you'll see they're actually cash flow negative because it shows them pulling money from assets in order to cover all that they need to live their life, but they're still growing over time because they're earning a rate of return that is greater than what they're pulling out from a percentage basis from their assets in a given year. So looking at their total expenses, I think this is really telling. So you'll see here, the blue bars are living expenses, stays relatively stable throughout their life. It's going to continue to increase by inflation. This light blue is just the liability payment, which is the mortgage payment that we have ending somewhere in 2028, if I'm reading that. And you'll see taxes, they start to gradually grow over time as they get older. And right here's where required minimum distributions start. So taxes paid, we'll see here, this is where they're going to increase pretty significantly. It was John's 75. And then again, when Jill reaches 75, so we're going to start taking money from her as well. So you'll see taxes paid continue to gradually grow all the way up until Jill reaches age 90. We're expecting her to have to pay $303,000 in taxes at that point in time. So what we want to do is let's compare taxes under the base facts compared to the plan where we are maxing out that 24% tax bracket immediately at John's 65. So what you see here is we're accelerating, just from the graphical representation, we're accelerating the tax payments that they're making in the first 15, 16 years of retirement here. But then because we've successfully converted all of John's IRA money into Roth IRA at this point in time, we've completely eliminated their tax burden in future years, or essentially they're going to pay a small amount. So what you're going to see here is let's compare the taxes paid column. In 2025, they only paid about $14,500 worth of taxes versus the plan where I have them paying an additional $75,000 worth of taxes and about $91,000. So we've actually accelerated their taxes paid by quite a bit. But where they make up for that is, let's go to a point. This is the crossover point, and this is where John's 81 years old. We've successfully converted all of his money to Roth dollars, and he no longer has to take required minimum distributions because there's nothing in that traditional bucket anymore. So they're only paying about $100 worth of taxes a year for the rest of their life because we've successfully converted everything to Roth dollars. Whereas if they made no changes, they're looking at a delta of about $127,000 a year each and every year. And that's only going to continue to grow as his required minimum distributions grow. So you'll see this is really the huge value add, is this tax savings over time. So the total expenses are literally more than cut in half over this time frame. So looking at it from the asset picture, which we'll update here, what's happening? A couple of things are happening. The total assets are going to break even by age 81 for John. So this is where we're going to see more value by taking on the strategy. Now that difference is just going to continue to grow over time. And the big caveat here is we've converted more money to Roth, so required minimum distributions aren't as large as what they would have been had we not converted them to Roth. And the other thing is we can be relatively aggressive with how we invest that because we know that this couple isn't going to run out of money. So we're just going to continue to grow this Roth bucket as big as possible. That'll be in this tax deferred bucket here. But what you're seeing is the effect of not having to pay as much tax over time, especially when you have a little bit of an age gap between two clients that we need to account for. So we've saved this couple about $8.3 million in taxes and accumulated investment earnings, an $8.3 million difference as opposed to if we did nothing. So the left-hand side, they're not poor. They're not like poor off. They're still in good situation. They're worth $13 million by the time the second spouse passes. But just by optimizing a distribution strategy, they're worth $21.3 million. So an extra $8.3 million by taking those taxes out early, paying them early, shifting that money to Roth, and just having a more efficient distribution strategy. So next up, we're going to talk about something called IRMAA. And IRMAA is an income-related monthly adjustment amount to your Medicare premium. And the big idea here is Medicare premiums aren't fixed. They're based on income. And if your income is too high, thanks to required minimum distributions, Roth conversions, or capital gains, your monthly Medicare Part B and D premiums can jump by hundreds of dollars per person per month. And even worse, Medicare uses a 2-year look back. So what you do this year can affect premiums 2 years from now. So if you did a big Roth conversion in 2023, or you made a bunch of money because one spouse was working while the other one retired, and you went on Medicare, that might cost you money on your Medicare bill in 2025. So it's just something to be cognizant of. And we help clients plan around these brackets and phase-ins because IRMAA is one of the most frustrating parts of the tax code because often it's accidentally triggered. In the case of John and Jill, we're sacrificing higher IRMAA surcharges to optimize for Roth conversions early in retirement. And then later on in retirement, those IRMAA surcharges are going to fall back to the base level for them. And I'm okay with that trade-off because as you saw, it's going to cost them roughly an extra $5,000 a year in IRMAA surcharges, but we're going to offset millions of dollars in taxes for that. So for the next 16 years or so, they're going to face higher IRMAA surcharges because we're optimizing or planning to convert most of John's 401k into a Roth IRA. And then they're going to fall back to the lowest level of surcharges once we've successfully converted all of John's money. So by the time he reaches 82 or 83 years old, this is going to be a moot point. And for you, this might be a little bit more complicated. So I would urge you to connect with a financial planner to see where your optimal trade-off is, because what you don't want to do is only be saving a couple of thousands of dollars a year in retirement to have a higher IRMAA surcharge each year. So it's typically something that's not as big of a deal if you've saved a bigger balance, but as we shrink the balance that you've saved, IRMAA surcharges become a very real and costly penalty, especially if they're not offset by tax savings as you're doing through Roth conversions. Did you know that up to 85% of your Social Security benefits can be taxable? This usually shocks people because many assume that Social Security is a tax-free benefit that we receive from the federal government. But once your provisional income, which includes things like IRA withdrawals and half of your Social Security, crosses a low threshold, which is typically like $44,000 for married couples, most of your benefits will become taxable. So even if your Social Security check is $40,000, you can end up paying tax on $34,000 of that distribution. Add that to your RMDs, pension, and investments, and your tax bill adds up very quickly. So what I'm going to do is I'm going to break down provisional income for you because I want you to have an idea of how to properly plan for your Social Security along with all of these other facets of your retirement so you pay as little in income tax on your Social Security distributions as possible. So the next thing we want to talk about is your provisional income. So the provisional income is made up of your adjusted gross income, which I have written down there in blue, your non-taxable interest income, which I have written down there in red, and 50% of your Social Security benefit. Add all those numbers up, and that's going to give you a provisional income number. So the next thing you want to do is you want to take this provisional income number and you want to plug it in to this table I have written below. And this table written below is going to determine whether your Social Security benefit is not taxable at 50% or taxable at 85%. So for somebody who's single, if your provisional income comes in less than $25,000, you don't have to pay anything in the way of taxes on your Social Security benefit. But if it's between $25,000 and $34,000, which I'm going to highlight in yellow here, you're going to have to pay 50% of your benefit. Now, for somebody who earns above the $34,000 threshold, which I'm looking at right here, you're going to pay 85% of your Social Security as a taxable benefit. Now, fast forward to somebody who's married filing jointly, those lower bounds is $32,000. So if you make less than $32,000, it's not taxable. But if you make between $32,000 and $44,000, it's now 50% taxable. If you make over $44,000, it's 85% taxable. So now you see how provisional income is going to affect the taxability of your Social Security moving forward. Now what I want to do is I want to talk about the one big catalyst that many people don't really take into consideration, and that's the non-taxable income. And non-taxable income is typically, in my experience, made up of two sources that you really need to be cognizant of. The first is municipal bond interest. So we'll just write muni bond interest here. And the second is private activity bond interest. So we'll write private activity bond interest here. And these are two things that are typically not taxable under the normal schedule, but are taxable under the provisional income threshold when trying to figure out Social Security. So municipal bonds are just triple tax exempt bonds that you would buy in order to not have to pay taxes on the interest you earn. But for provisional income, these are added back. So if you live in, I live in Pittsburgh, so Allegheny County. So if I live in Allegheny County, I buy an Allegheny County municipal bond, it's triple tax exempt for me, meaning I don't pay federal, local, or state income tax on it. But that would be added back to my provisional income in retirement when I'm trying to figure out my Social Security benefit. Now, private activity bond interest income is added back, and that's for things like, again, I'll keep with the Pittsburgh example here. Let's say the Steelers want to build a new stadium. That's considered a private activity bond that they're using to raise money to build that stadium. I would have to add back that interest income to my provisional income line item because I invested in this private activity bond to help them build a new stadium. So that's just two examples of things that would be added back in to your non-taxable income. So things that aren't included, though, what I want to write about, and just say they're not included. Oops, it helps if I could spell right. And let me fix this a little bit for you so it looks better. So things that aren't included would be Roth IRA distributions. That's the first one. So having a Roth IRA distribution as opposed to traditional IRA distribution would help your provisional income number. Second would be interest from savings bonds. And then third would be regular bank interest. So what you earn at the credit union you do your banking at, or the major bank that you have your savings or CD investments at. These would be things that don't add into provisional income. So when structuring your investments, it's important to think about how you're setting up your allocation or your portfolio. So that way we know what's going to be an add back for Social Security tax and what's not going to be an add back for Social Security tax. And where you want to find all of this, it's on your form 1099 interest, and that's specifically line 2A or box 8. That will show where all of this pops up. This will show your breakdown of the exact types of interest that you're earning. So that way you know what's going to be included in provisional income and what's not going to be included in provisional income. Before we go any further, I just want to remind you to subscribe to this channel. I'm sure you found some money-saving tips up to this point in the video, and I want to make sure that you keep getting these money-saving tips weekly. That's how often we post videos, and that's how often I want to make sure we're solidifying your financial future. So please make sure you're going to continue to get these money-saving tips by clicking that subscribe button right now. Thank you so much. Let's jump back into the content. Now we're going to talk about one of the most often overlooked tax traps. That's the widow's penalty. And the idea behind the widow's penalty is that a surviving spouse will pay more in tax as opposed to if both spouses were still alive. So when one spouse passes away, the surviving spouse moves from married filing jointly to single tax filer status. But often the income doesn't drop much. Things like Social Security, required minimum distributions, and investment income will continue on, often at higher levels than they were in the past. And the result here that higher marginal tax rates, faster phase outs, and higher IRMAA brackets will cause a double hit. Not only will they have emotional loss, there's going to be financial penalty here as well. This is often why I will urge clients to start Roth conversion sooner rather than later, especially if one spouse is significantly older than the other or does not have as long of a life expectancy. I have seen firsthand this situation play out. In fact, clients I have projected to have a 24% tax filing marginal bracket at the federal level when filing jointly often will be pushed into 32 or 35% brackets some point in time in their life after one spouse passes. And that means an additional $8,000 to $11,000 a year in income on a $100,000 distribution, just at the federal level. And it excludes things like the state tax level, the local tax level, and some other taxes that we'll talk about later on in the video. So planning for this in advance through things like Roth conversions, survivor benefit elections, and income smoothing can make a huge difference in your retirement outlook. So now we're going to talk about a lesser known retirement tax trap. And this is the net investment income tax. And this is once your modified adjusted gross income crosses over the $250,000 point. You're hit with an additional 3.8 surtax on investment income. And this is going to be limited to the lesser of your investment income or the amount your modified adjusted gross income is over that $250,000 threshold for a married couple. If you're single, that threshold's $200,000. So this 3.8% will apply to the following things: capital gains, dividends, rental income, or trust income. So if you sell a property, take a large distribution, or have sizable dividends, this kicks in on top of everything else. There are a few ways to avoid this tax or at least mitigate it. And I find investors typically run into trouble when they don't optimize for asset location. So here's a couple rules of thumb that I follow to help my clients eliminate this tax. So we want to avoid dividend stocks or dividend paying funds in non-qualified accounts. Save those for their IRAs. We want to try to avoid mutual funds with historically high capital gains distributions in non-qualified accounts. Again, save those for your IRAs. We want to try to sell capital gain property in years in which you can offset some of the gains with capital losses. Finally, we want to practice diligent tax loss harvesting over many years to eliminate capital gains along the way. So that way we're not having a year in which we're realizing huge capital gains, tipping us over on the modified adjusted gross income scale and getting an almost additional 4% of that taken away from us in the form of a federal tax. So by the time clients factor in federal capital gains taxes, state capital gains taxes, and the net investment income tax, it's not uncommon to be approaching the 30 to 35% level on overall taxes on capital gains distributions. With proper planning, this cost can be cut in half or eliminated completely. One strategy I've seen a lot of my clients take is moving, and where you live does matter a lot. Some retirees relocate in retirement, often to be closer to kids or grandkids, but moving from a no-income tax state like Texas or Florida to a high-income tax state like California or New York can dramatically increase your tax bill. We've seen a lot of clients go from paying 0% to over 10% on their retirement withdrawals simply because of a change in zip code. Before you move, talk to your advisor. The cost of sunshine and grandkids might be higher than you think, but it's also important to consider factors such as sales tax, property tax, and insurance rate adjustments into this calculation as well. It's not quite as simple as looking at a state tax rate and moving to optimize just on that. Because what I've found, especially recently with the higher insurance rates on condos or townhomes or houses just in general along like the Florida coast, is that when by the time you factor in property taxes and the higher insurance amount, we're often netting even or we're exceeding what we'd have paid in a higher income tax state. I'm in Pennsylvania. We have a lot of retirees who will go south for retirement. Oftentimes I'm finding they're not saving more than the additional 3% in state income tax by moving to a no income tax state. So it's important to cross all of your T's and dot all of your I's and account for all of the different cost adjustments, positive and negative, when moving from a state where you're taxed on your income to a state where you have no income taxes. So do you want the bottom line? Retirement taxes don't just affect the wealthy, they punish the prepared. If you saved well, you need to plan even smarter. These hidden tax traps, required minimum distributions, IRMAA, Social Security taxation, the widow's penalty, surtaxes, and even state moves can eat into your retirement faster than you think. But with proactive planning, you can reduce the damage and keep more of your hard-earned wealth. If you want help building a plan to reduce retirement taxes, reach out through the link in the description. And don't forget to subscribe for more retirement insights. Thank you so much for watching, and I'll see you in the next video.